A heated debate emerges within the Federal Reserve over interest rate cuts. A growing debate is unfolding inside the U.S. Federal Reserve over whether to begin cutting interest rates later this year. The division among policymakers reflects rising uncertainty about the trajectory of inflation, the labor market, and the broader economy. Christopher Waller, one of the Fed's governors, recently signaled openness to lowering rates in the second half of 2025, if inflation continues to move closer to the Fed's 2% target. Waller noted that the economy remains resilient, and as long as job growth holds steady and price pressures ease, a rate cut would be appropriate. He also downplayed the impact of the Trump administration's newly proposed tariffs, suggesting they might result in a one-time bump in prices but wouldn't necessarily derail progress on inflation. On the other side of the spectrum, Dallas Fed President Lori Logan adopted a more cautious tone. She emphasized the need for patience, arguing that the central bank should wait for more data before making any policy shifts. Logan warned that new tariffs and rising inflation expectations could become entrenched if not carefully monitored, which could pose long-term risks to economic stability. This internal divide follows the release of the minutes from the Fed's May 2025 meeting, which revealed rising concerns over stagflation, a troubling combination of slowing economic growth and persistently high inflation. Several officials expressed fear that tariffs could amplify inflationary pressures while simultaneously dampening consumer spending and business investment. Markets have already begun responding to these developments. The U.S. dollar fell to a 6-week low amid investor uncertainty, and oil prices surged by 3% after OPEC Plus reaffirmed its commitment to production cuts. These movements suggest that global economic forces are adding complexity to the Fed's already difficult balancing act. For now, the Fed is expected to hold interest rates steady at its next meeting. However, all eyes will be on future inflation data, employment reports, and any signs of weakening demand. The central bank appears ready to act if necessary, but is proceeding with extreme caution as it navigates this delicate economic landscape.